Hi, good morning clients and TR. Thanks for tuning in to our webinar this week. For this week, we're going to have three company updates: City Dev, Sembcorp Marine, and Soilbuild. And then lastly, we're going to do the Phillip ETF Model Portfolio update. So I'll start off with City Dev. Oh, sorry, I'm Teo Hong here. I'll start off with City Dev because they had two announcements over the last 2 weeks. So the first one is 2 weeks ago, we saw them announce the en bloc of Amber Park. That was at the land rate of 1,005 PSF. And the second announcement was the one last week where they made the offer, the potential offer for the remaining 35% shares for Millennium and Copton, which they don't own yet. At the offer price was 553 pence per share. So what we know is that the announcement does not constitute an offer, it's a potential offer, and they have until the first week of November to make a finalized offer. So what we think of the deal is that the offer price at 553 pence per share is at a 24% premium to the last close price. But despite this premium, the offer price actually offers attractive value still for CDL, because you see that the offer price is actually 0.7 times book of what MNC is actually having in its accounts. So we know that the hotels are actually held in the books at cost, and your takeover offer is actually at a 0.7 times book. So effectively, you are 0.7 times cost, and not the revalued valuations every year. So if you look at the discount to the book value of 30%, you see that the 30% discount is actually still a larger discount than the peer average valuation. We look at the three closest peer competitors listed locally. We look at Shangri-La Asia, Banyan Tree, and the last one is Amara. All three have very similar models. They are hotel operators with a large proportion of hotels that are owned by the company itself. So you have two categories of hotel operators. One is the asset-light model, where they basically just do a hotel operating without owning the hotels. And the second one is where they operate and own the hotels at the same time. So if you look at the three competitors, their average valuation right now is about 0.98 times. So if the deal were to go through at 0.7 times, that's going to be quite a good deal for CDL if the remaining shareholders accept the offer. And post privatization, if the deal goes through, we will see our revised RNAV go up to 1590 per share, and you will see that at that stage MNC will make up 27% of CDL's total GAV. So what we think of the potential reasons for the offer is that, firstly, pre-offer MNC was trading at a very big discount to book. It was trading at a 45% discount to book. We see that post GFC, a lot of these hotel operators, they have run up a pretty good deal, and I think the market is discounting all these operators with own assets to a bigger extent, and that explains the bigger discount that MNC was trading at before the offer. So the low valuation is one, and we know that the GBP has fallen quite a fair bit since Brexit. That's number two. And lastly, we know that the outlook for hospitality across the world, they're improving as well, along with the global economic recovery. So I think these are likely reasons for the offer. And so back to the event number one that I mentioned, that is the en bloc for Amber Park. That one is, I would say, a bullish tender, because at a land cost of 1,515 PSF, if you factor in a break-even cost of close to 2001, throw in margins of in the teens, you're looking at launch price of close to maybe 23, 24, or 25. and at that price you are looking at a premium upwards of 30% versus what similar properties of the same size are trading in the vicinity. Similarly, freehold properties in the vicinity currently doing about 1,008. So effectively, management is forecasting an upward of 30% increase from the current price. Let's say they launch it maybe 1 year from now or 2 years from now. So 30% upside in property prices 2 years from now. All in all, for CDL, we maintain an accumulate rating. Our target price is unchanged as of now, but should the acquisition go through post-consolidation of MNC into the books, we will see our NAV increase to 15.90 per share for CDL from the current 13.50. Oh, sorry, this is a typo. Our NAV will increase to 15.90 and 13.50 will be the new target price versus 12.10. 13.50, the new target price is a 15% discount that we take to the RNAV for all our large cap property developers under our coverage. And if the deal were to go through, it would still represent a good proxy for investors who want exposure to the Singapore residential market, because post consolidation, Singapore residential will still make up 31% of the adjusted gross asset value for CDL. And if you include properties in other sectors, you include your offices, your hotels and all that, Singapore exposure for CDL still stands at 56% of the adjusted GAV. So with that, I'll pass on to Guang Zhi to talk about Sembcorp Marine.
Hi, good morning. It's Guang Zhi here. So next we will take a look at Sembcorp Marine. So after a few announcements of contract termination, finally Sembcorp Marine announced some relatively positive news 2 weeks ago. So our title is Some Drizzle in This Drought. So about 2 weeks ago, Sembcorp Marine announced that they succeeded in selling 9 Pacific Class 400 jackup rigs to Ball Drilling Limited. So the total amount of this deal arrived at 1.3 billion US dollars, roughly around 1.8 billion Sing dollars. And the delivery of these 9 rigs will be done in 14 months, starting from 4Q this year to 1Q of 19. So Sembcorp Marine will receive the upfront payment of 500 million US dollars at this point of time, and the rest of the 800 million US dollars will be received in 5 years. So all in all, the Sembcorp Marine will be subject to a net losses of 50 million Sing dollars, and this amount is excluding all interest and market fee payable by Ball Drilling. So how do we view this deal? We think that this sizable deal will provide liquidity, because you can see here in the first half of this year, Sembcorp Marine's working capital requirement reached 440 million Sing dollars compared to last year's 170 million Sing dollars during the same period. As a result, Sembcorp Marine's borrowing rose from 4 billion in June 16 to 4.4 billion Sing dollars in June 17. So there is no doubt that its interest burden increased a little bit. So as Sembcorp Marine received the 500 upfront payment of cash, this amount of capital can either be funded the working capital without escalating the indebtedness, or to replace the part of its borrowing to reduce its interest expenses. So another good point is we think that Sembcorp Marine is catching up with the market turnaround. So as you can see here in the figure 1 here, shows the total world rig count and the Brent price. As you can see, since the third quarter of 16, both the active rig count as well as the Brent price bottom out until now. As those 9 rigs fell into the category of this IC 350 plus, so we monitor its utilization rate and its rig count around the world. So you can see here in figure 2, since earlier this year, this type of jackup rigs utilization rate increased from below 60% to the recent high of 65%, and also its rig count in the world also bottomed out since February. So we think that there are momentums that the upstream players, like those rig operators and owners, started to defrost their capex after more than 1 year's budget cut. So we do think that Sembcorp Marine has been actively checking the market closely to grapple the opportunities when the market started to turn around. However, we think that the deal will further weaken its profitability because of the net loss of 15 million Sing dollars. So we think that this may be a compromise outcome for Sembcorp Marine, since Sembcorp Marine got rid of these 9 rigs at a price that below its building costs, which we think that the amount is quite significant because the prolonged weakened profitability in the near term. So we think that this year the profit margin will be further lower because as of now there is no new sizable orders coming to the order book. So because of lacking new order books, because of lacking new orders, without replenishment of sizable deals from jackup rigs, we think that its profitability won't turn so soon. So for the market outlook, we think that the market is starting to thaw as all these rig owners began to unwind their capex. Probably they will source their deals that are below the fair value. So the sources of these jackups will come from the stockpile of the newly built rigs without contracts, or from those builders facing insolvency issue. Overall, we think that it will take longer than expected period for the new orders to come in. So we upgrade our rating from reduced to neutral with a higher target price of $1.82, as we maintain our FY17's EPS of 5.4 SG cents due to the weaker than expected performance in the first half of this year, and a higher updated blended forward PR of around 33.6 times. We derive a higher target price. So next I will pass on to Richard to talk about Soilbuild Business Space REIT.
Hi, good morning. Okay, so the major change is that we have downgraded the rating to reduce, and also the target price has been lowered to 64 cents from 73 cents the last time. We'll look at the two big, more important numbers from the results first. So you can see revenue here grew 4.1%. This was mainly from the acquisition of Bukit Batok Connection. It was acquired in the third quarter of last year, and it contributed 4 days worth of rent compared to this year where it has a full quarter of rent. And this helped to cushion the effect of the the tenant default at 72 Loyang Way. For DPU, it's lower 1.8% year on year, but take note that there's a difference this year where management fees was paid in cash, whereas last year it was paid in units. So there's less cash this year for distribution, and so that affects the DPU. So if our estimate for adjusting that out, if the manager is taking fees again like last year, then DPU would have been up 1.5%. So there's some positive in the results. There was quarter-on-quarter improvement in occupancy for the portfolio. Quarter-on-quarter, it improved from 92.6 to 94.1%. This was driven by West Park Beach Central and 72 Loyang Way. However, this has been marred by several of the tenant defaults. So we start first in chronological order, starting with 72 Loyang Way, where it used to be tenanted to Techniques Offshore Engineering. So now it's about 27% occupied, so meaning about 70% of the property is still vacant. That's about 148,500 square feet of space. The manager has said that it's quite difficult to secure another anchor tenant from the offshore marine sector for this large space. They need to find an anchor tenant to qualify the 70-30 rule. And the thing is that there's actually competing supply just down the road at Loyang Crescent. It's a smaller property, about 49,600 square feet. Next is NK Ingredients. So a few weeks ago, NK Ingredients defaulted already, and then last week, Soilbuild REIT has managed to collect the security deposit for the arrears, and now the tenant has 7 days to top up that shortfall in the security deposit, which is supposed to be for 12 months of rent. So the 7 days will be up tomorrow on Tuesday, and we'll have to wait and see what action will be taken against the tenant if the tenant fails to top up the security deposit, but quite likely we'll have to ask the tenant to leave already. And then in this quarter's results, the manager has also disclosed that a third tenant, KTL Offshore, is also having collection issue. So they are now in 7 months of arrears, and the remaining insurance bond is adequate up to around May or June 2018. Take note that KTL Offshore is a wholly owned subsidiary of KTL Global Limited. It's listed on the Singapore Exchange, and the parent already has been flagged by the independent auditor on doubts on its ability to continue as a going concern. So at this point, we are not too optimistic on KTL Offshore surviving this period as well. So just to recap, the main reason for our downgrade in rating to reduce is all these tenant defaults and the uncertainty of their cash flow going forward. Now we'll move on to Sai Ting, who will talk on the ETF Model Portfolio.
Very good afternoon to you all. Today we're touching a little bit on the Phillip ETF Model Portfolio. Some of you might have known that Phillip has been running this portfolio for quite some time. You should have seen it through mailers or the website itself. This is a product that came out from Phillip Research, and it's a very simple portfolio, and we don't really run real money behind it. It's a hypothetical portfolio. And we like to showcase you the kind of results that we are seeing. All these results, please note that they are back-tested numbers. So without further ado, let us go into the performance for at least until the end of September. So the 1 month result you can see actually is from September, and just to guide you guys, we actually run two different portfolios. One is SG listed ETF. We use the SG listed ETF to construct the portfolio, and the other one is actually using the US listed ETF to construct the portfolio. The methodology, philosophy are all the same. It's just that the investable instruments is a bit different. So within each individual markets, for example, the SGX markets, we have three different kind of portfolios catering to different risk classification: aggressive, balanced, and conservative. The name itself is actually foolproof. So if I do just guide you through the numbers, you could see that beyond 1 year, we are looking at actually accumulative numbers, not annualized numbers, and the numbers are all showing positive result. This is not unexpected, as you know that since if we go to track back 5 years ago, we are still being somewhere in the middle of 2012. Those were the recovery period from the global financial crisis. So although it might not be a very telling sign, because we all know that equity market since 2000, at the bottom of 2008, has since then been on the uprise. What we do care about is actually how it will perform, and we will show on later how it will actually perform during the downturn, or at least the results from our back tested results. What does it show us? So this is just to give you guys to have a favor. In fact, if you look at I think year-to-date comparison, you should look at them. They are doing pretty decently, considering that they do have fixed income exposure to them as well. So it might even beat a few of the all equity indexes. So just to for those that are unfamiliar with this product, this model portfolio, is actually on the top part here, you can actually see is the asset allocation. At the bottom part is actually the investable instruments that we uses to construct this portfolio. So for example, if I were to point out to you the aggressive model portfolio, for example, when we're talking about gold, 15% allocation to gold, we're actually looking at, in Singapore listed ETF, we're talking about the SPDR gold shares ETF, or in the US listed an equivalent, also the SPDR gold share ETF. So the bottom table shows you the investment vehicles that we use. The top charts, or these pie charts, actually showing you the allocation to these equities. Do know that a lot of people might be asking. I mean, when we first started the project, a lot of people are asking, why is it 10%? Why is it 20%? A lot of these are actually based on our back-tested results that we did for the past 2 years when we was running a similar portfolio for a unit trust product. What we do understand is that developed markets such as US, European, and the Japan market give us a lower volatility return, and therefore when we first built a portfolio such as this, the developed markets was the cornerstone for the equity portion of it. Obviously, you have your fixed income that we have divided. Clearly, we want to keep it simple. We don't want to add in too much complication, because we do understand that first of all, there's the investment grades, there's high yields, there's short duration, there's long duration, there's sovereigns and things like that. But we want to keep it simple, so we divide our fixed income purely into short-term bonds as well as sovereign credits. That will be all inclusive. And if you look at the whole construction, is generally quite simple. If you it'll be just the major asset classes will be just your fixed income, your equities, which we will divide it into regional. You have your US, European, Asian, ex-Japan, Japan, as well as, of course, we cannot ignore China. And then under the alternative space, we have actually added gold, which our research has shown us that gold gives a different kind of diversification relationship or dynamics to just a pure equity and fixed income portfolio. So here, just don't have to bog down by the numbers, just take a look at what the current allocations are. This is the correlation table for the listed ETF. These are not the underlying indexes that are tracking, so the data might be a bit on the shorter end. But nonetheless, we could see that the negative correlation between fixed income as well as equity, which has been very clear. If you look at the ABF Singapore Bond Fund and the correlation it has to the other equity markets, so you could see that it's negatively correlated. Why is this important? Because when we construct a portfolio, it helps to diversify any form of risk. So when something bad happens to the equity market, we know that we have our fixed income there that will definitely give a negative correlation. And of course, you look at gold, although gold are positive, somehow minorly positive to some of the equity markets, they are in general still negative to certain of the credit markets as well as the Japan equity market. So this is the other table, which is just showcasing you the other sets of instruments that we use that's listed on the US listed on US similar results. So these are just this is something that's actually more pertaining and more important when we try to showcase why such portfolio can be beneficial for all our investments. If you believe that, if you take a look, we're just looking at the US proxy for now because US have a longer history. If you look at the aggressive portfolio, conservative, or balance all the way to conservative portfolio, if you believe that, if you look at the calendar years, then you believe that the proxy that we are using actually derive similar results. If you look at 2016, for example, US aggressive portfolio returned 4.2% for the whole year, and the proxy returns 4.1. It's actually quite close. The proxy we are actually using is the underlying index that's actually that the ETF is actually tracking. So obviously, the results will be very, very similar. So if you believe that we are using the right proxy, then I would like to draw your attention to 2008, where that was the financial crisis right at the bottom. And we know that how well our proxy portfolio has been performing as compared to, let's say, for example, STI for that year, as well as the S&P 500. STI dropped about 44%, S&P 500 dropped about 38%. If you look at our most aggressive portfolio, you know that it has only dropped by about 28%. I mean, not too shabby, but obviously with a huge percentage exposed to the equity markets, you do expect this kind of at least a more than a two-digit drop. But what's more important here, first of all, this showcases us one thing, that it helps to limit our downside as a whole portfolio. And what I want to draw your attention to next is actually looking at the three tables below, which obviously states the aggressive, balance, and conservative. So what are these numbers that we are showing here? It's actually very simple. These are all the back-tested results. So these are in monthly format. So the number of periods that we're analyzing are in terms of months. So it draws all the way back to 2007. And if you look at the number of up months and down months, so this actually covers all the way back to prior to the peak in 2007. So I think somewhere in 2006, we have these numbers to show us when we go through the great financial crisis, what actually happens. I think that's a more valid kind of comparison. So we know that if you look at our aggressive portfolio, we are up about 87 months compared to in total of the 136 months that we are actually analyzing. And that actually translates to about a 62%, if you can consider as a win rate. So out of the number of months that you have stayed invested, 62% of the time or 63% of the time you have been up, and by an average of 2.66%. So the average there shows you the positive and negative, the monthly return. So on average, you know that when you're up about 2.6%. The next thing you want to look at is, I'm just purely talking about the aggressive portfolio here. So if you can follow me through the bottom left table, the next thing you want to look at is actually the standard deviation, which is at about 3.58%. Which means that you know that the returns that we're seeing, it won't be that far off. If I were to put this into in relativity, you know that S&P index standard deviation is about 10 to 12% in terms of standard deviation. and we are having a portfolio that's a standard deviation of 3.58. For those that are not familiar, standard deviation actually, in layman terms, actually your volatility. So we're having a constant return about, on average, inclusive of the negative periods, an average of about 0.63 return on the monthly return, and you know that it doesn't deviate too far away from it. If you to compare that to some of the other unit trusts that you might have purchased, or some of these actively managed funds, their standard deviation can be as high as 20 or even between 15 to 20. So what we these numbers, these statistics actually show us something that we have actually achieved in actually trying to lower the volatility of such a return. The return might not be fantastic, but obviously we are also looking to protect the downside. And with that, we have come to the end of today's presentation. Do feel free to ask any questions. Please feel free to ask any questions if you have any regarding our company coverage as well as ETF portfolio. For those that are actually interested in looking at the underlying ETF that we use to construct the portfolio, do take a look at the current slides right now. At the bottom of at the bottom table, the Singapore listed as well as the US listed ETF.
There is a question asking about whether based on Sembcorp Marine's situation, we will see a turnaround of the rig industry as a whole? Our answer is no. We think that the upstream side still will take longer than expected time to recover, especially the drilling solutions. However, for marine side, we see that recently quite a few of the order flows from vessels and LNG floating solutions comes into the order book. So we think that the marine side will recover soon, and it will recover faster than the rig industry. Thanks.
All right, since there are no more questions, we'll end the webinar here. See you again next week.